Welcome to This Explainer. Okay, so can complex charting tools and fancy algorithms actually help you predict the stock market, or are you honestly just better off buying, sitting back, and doing absolutely nothing? Let's find out.
It's kind of the ultimate mystery, right? I mean, every investor wants this solved. For decades, we've had Wall Street pros and casual investors totally locked in this debate. Can technical trading, trying to time the market using complex models, actually beat a plain vanilla buy and hold strategy?
To actually answer this, we're diving into a really fascinating master's thesis in finance by Robin Lingviken and Eric Lindquist. In their paper, Technical Trading Strategies, they took these famous financial strategies and put them to the ultimate test. They crunched an absolute mountain of historical data, and we're going to see exactly what they found. Here's our roadmap for this explainer. We'll cover beating the stock market, the efficient market hypothesis, the technical trader's toolkit, testing the Swedish market, and finally, the final verdict. Section 1. Beating the stock market. Crystal ball versus dartboard.
Humanity has literally always been obsessed with forecasting the future, especially financial futures. We're just wired to look for patterns. And in investing, this really splits into two main camps. On one side, you've got fundamental analysis. That's digging into a company's actual business health, earnings, that kind of thing. But on the flip side, you have technical analysis. This is where you attempt to predict future prices strictly by looking at past price patterns. For this explainer, we are putting that technical side right under the microscope.
Section 2. Efficient market hypothesis explained. The unbeatable market. Now, if technical traders are the eternal optimists, the efficient market hypothesis is absolutely their main antagonist. It basically asserts that markets are highly efficient and they already reflect all available information, which means you simply cannot use historical prices to gain an edge. To really hammer that point home, we have this mic drop quote from economist Burton Malkiel. He says, the strongest evidence suggesting that markets are generally quite efficient is that professional investors do not beat the market. Honestly, if the pros can't reliably do it, how on earth can the rest of us?
Section 3. The Technical Trader's Toolkit. Weapons of choice.
Okay, let's dive into this toolkit, starting with the SMA, or Simple Moving Average. What this does is assign equal weight to historical price data to create a running average. It essentially smooths out those really volatile, jagged daily price curves so you can actually see the underlying trend. Now, traders will often use two of these together, a short-term and a long-term SMA. When that short-term average crosses above the long-term one, that generates a buy signal. And when it crosses below, boom, it's a sell signal. Next up, we have the MACD, which stands for Moving Average Convergence Divergence. I know, it's a mouthful, but just think of it as a momentum speedometer. It measures a long-term moving average, usually 26 days, right against a short-term 12-day one. By watching exactly when and how these two lines interact and cross, traders are trying to spot whether an upward or downward trend is actually gaining or losing its strength. Our third major tool here is the RSI, or Relative Strength Index. Picture this as a kind of tension gauge that scales from 0 to 100. So if the RSI stretches up above 70, the stock is considered overbought, meaning it might be due to snap back down soon. But if it drops below 30, it's oversold and might just be getting ready to bounce back up. Section 4. Testing the Swedish market, the laboratory. To actually test these tools against that efficient market hypothesis, our researchers had to build a really rigorous laboratory. They used the OMX Stockholm 30, which tracks the 30 most frequently traded stocks in Sweden. And they didn't just look at a few months, they looked at a massive 12-year window, spanning from the start of the year 2000 all the way to the end of 2011. To ensure the results were totally robust, they broke this giant time frame down into 4 distinct 3-year subperiods. This was super important because it meant they were testing the strategies across completely different types of market conditions. So what were the rules of this experiment? Well, they tested those moving averages right alongside the RSI and MACD and then compared them against a totally passive buy and hold baseline. But here's the real kicker, the hidden variable they made absolutely sure to account for: transaction fees. Brokerage fees are kind of the hidden villain in the trading world because remember, every single time you trade, your broker is taking a cut. Section 5. The final verdict. Busted or plausible? 0 out of 12 entire years of massive data crunching. The researchers found exactly 0 statistically significant excess returns generated by these technical trading strategies when compared to simply buying and holding. Literally none. 0. Let's just break down the harsh reality of these conclusions. First off, there were no excess returns from all that intense charting. Second, those fancy trigger indicators we talked about, the MACD and RSI, they did not improve performance at all. And third, those transaction costs completely ate the profits. The constant buying and selling just continuously chips away at your money, which hands the undisputed victory directly to the simple buy and hold strategy.
So the absolutely crucial point to take away from all this is that for the everyday individual investor, a simple buy and hold strategy wins out over active technical trading. You really don't need a fancy multi-monitor computer setup running complex algorithms to be a smart, successful investor. In fact, trying to outsmart the market with those tools, especially after you account for the fees, is statistically likely to just make you worse off. It looks like the efficient market hypothesis holds its ground here.
Which leaves us with this final, kind of provocative thought. If 12 years of intense data analysis on the top Swedish stocks shows that even the most complex models can't predict the market well enough to beat a simple baseline, is it maybe time to stop trading and actually start investing? It's definitely a fascinating question to ponder for your own financial journey. Thank you so much for joining me in this explainer, and I really hope this deep dive helps you make more informed decisions moving forward.